After studying this module, you shall be able to know how bond prices and bond yields are determined. Learn how current and expected future short-term interest rates influence bond prices and yields. Understand the concept of yield curve and term structure of interest rate, and also able to understand and analyze and also interpret the slope of yield curve. Definition of bond. Bond is a debt instrument issued by the issuer, government or company to raise funds and provide regular interest payments in addition to paying their face value. Face value is the amount that will be paid when the bond matures at maturity to bondholders. Different bonds may bear different default risk depending on the risk that the issuer of the bond will not pay back the full amount promised by the bond. Here in this module, we focus on bonds issued by identical borrowers. The only differences are differences in the times at which the bond matures. Before introducing the concept of the term structure of state, let us briefly look at the concept of yield to maturity. Types of bonds. There are basically 4 types of bonds. Foreign bonds. This refers to the bonds offered by a foreign entity to investors in a domestic market which is denominated in that country's domestic currency. For example, bulldog bonds are pounds denominated bonds issued in the United Kingdom by a foreign company. The second type of bonds are euro bonds. These are the bonds denominated in the currency other than that of the country in which it is issued. It is not necessarily in euro currency. A French company selling a dollar denominated bond in Japan is also an example of euro bond. Third type of bonds are government bonds. These are fixed income securities issued by government and are considered to be risk-free. The last type or the fourth type is corporate bonds. These are characterized by higher yields because there is a higher risk of a company defaulting than a government. The company's credit quality is very important. The higher the quality, the lower the rate of interest the investors would receive. There are some variants of the bonds. These are straight bonds. On straight bonds, the interest rate, also known as the coupon rate, is fixed in case of straight bonds. That is, the investors are paid regular and fixed interest payments during the life of the bond. We also have floating rate bonds. On these floating rate bonds, the interest rate is not fixed. Rather, it is tied to some reference rate such as London Interbank Offered Rate. We also have zero coupon bonds. In these bonds, no interest is payable over the life of the bonds. These bonds are sold at a significant discount from the face value, and at maturity, the investor gets the full face value. We also have dual currency bonds. These are issued in one currency and interest at fixed rate is also paid in the same currency. However, the principal amount is paid in some other currency. We also have convertible bonds. In these bonds, investor has an option to convert the bonds into fixed number of shares at a predetermined price and time. Yield to maturity is the interest rate at which the price paid for the bond would have to be invested to return the stream of payments generated by the bond. For example, having paid 1000 rupees for the bond, in the following year you will receive annual payment of 100 rupees and 1100 rupees face value. Thus, the yield to maturity on this bond is the interest rate I, which satisfies the following condition. 1000 is equal to 100 plus 1100 upon 1 plus I, which implies 1 plus I is equal to 1200 upon 1000 is equal to 1.2. Hence, yield to maturity for this bond is 20%. In general, yield to maturity for a bond maturing in n periods satisfies the following condition. That is, price paid is equal to x upon 1 plus I plus x upon 1 plus I square plus so on till we have x plus face value fv upon 1 plus I raised to the power n, where x is the annual payment to the bondholder. Term structure of the interest rate and yield curve. Term structure of interest rate refers to the relation between maturities of bond with its yield. Ceteris paribus, which means other things being constant. By ceteris paribus in this case, we mean the issue of the bond is same and the date at which different yields are obtained is also constant. The graphical depiction of the term structure of interest rate is known as the yield curve. It summarizes the yields of otherwise identical bonds of varying maturities at a particular point of time, as you can see in the figure. In the figure, we have term to maturity on the x-axis and yield in percentage on the y-axis. We have the upward sloping yield curve. We have 1 year and 5 year term of maturity, and the yields are 6 and 8% correspondingly. Yield curves can also be drawn for other debt instruments such as treasury bills. Yield curves can be upward sloping, downward sloping, or flat. We now explain theories to explain the shape of the yield curves. Expectation hypothesis. This is the first hypothesis, according to which long-term yields are an average of the short-term yields expected to prevail during the life of a longer-term bond. This hypothesis is based on the assumption that investors are concerned only about expected return from asset. If investors have option to choose from a 1-year bond and a 2-year bond, the decision would be based on the expected return from each type of asset after a year. For example, an investor has 1000 rupees to invest for 2 years. Current yield on 1-year bond is 5%, and next year 1-year bond will pay interest of I1%. Thus, if the investor purchases 1-year bond today and purchases another 1-year bond after it matures, in 2 years he will have Vs equal to 1000 into 1 plus 0.05 into 1 plus I1. The expectation hypothesis. Unfortunately, the investor does not know the yield on 1-year bond after a year. He relies on his expectation about future interest rate to estimate the expected return of buying series of 1-year bonds in 2 years. That is, Vs is equal to 1000 into 1 plus 0.05 into 1 plus E1I. Instead, if the investor invests in 2-year bond, the return after 2 years would be VL equal to 1000 into 1 plus I2 whole square. Since the investor is only concerned about expected return and hence is risk neutral, he will not purchase long-term bond if VL is less than Vs. In contrast, if VL is greater than Vs, investor will not purchase short-term bond. In fact, under the expectations hypothesis, the only condition in which both 1-year bond and 2-year bond is sold in the market is that where investors are indifferent between purchasing either of the two. That is, VL is equal to VS. Now suppose the investors expect next year 1-year bond yield would rise to 7%. That is, E1I is equal to 0.07. In this case, the yield on a 2-year bond that equates the expected return of holding a 2-year bond with that of a series of 1-year bond gives us the condition, that is 1000 into 1 plus I2 whole square is equal to 1000 into 1 plus decimal 0.5 into 1 plus 0.07, which is same as 1 plus I2 equal to 1.06. Hence, yield on long-term bond, here 2-year bond, is 6%. At this rate, investors can exactly earn the same return from both investments, which is VS is equal to VL is equal to 1123.5. This analysis reveals that according to expectation hypothesis, long-term yield is determined by expectations about short-term yields. The current yield on long-term bond will change if expectations about future short-term yields change. For instance, if the current yield on 1-year bond is 5% and investors expect the yield rate to remain at 5% next year, the yield rate on a 2-year bond will satisfy the condition, that is 1000 into 1 plus I2 whole square is equal to 1000 into 1 plus 0.05 into 1 plus 0.05. That is, I2 is equal to 0.05. Thus, if investors expect that yield on short-term bond will remain unchanged, then the rate on 1-year bond will equal that on 2-year bond. Similarly, if investors expect yield on short-term bond to fall to 3% next year, the yield rate on long-term bond is given by the condition that 1000 into 1 plus I2 whole square is equal to 1000 into 1 plus 0.05 into 1 plus 0.03. That gives us I2 equal to 0.4. This figure illustrates the yield curves for the 3 cases we just discussed. That is, when the short-term rates are expected to rise, when the short-term rates are expected to remain same, and the third case where the short-term rates are expected to fall. We have these 3 diagrams showing us the relationship between term to maturity and the yield in these 3 situations, where we have the short-term rate expected to rise, short-term rate expected to remain same, and we have the flat curve, and the short-term rate expected to fall. In general, yield on n years bond IN is given by the condition, that is 1 plus IN whole raised to power n is equal to 1 plus I into 1 plus E1I into 1 plus E2I, so on till we have 1 plus En minus 1 I. Solving for In from the above, we get In equal to the nth under root of 1 plus I into 1 plus E1I into 1 plus E2I, so on till 1 plus En minus 1 I. We can see that the amount we get from the above condition is very close to the simple average of the current and expected 1-year yields. In particular, if we take logarithm of the first equation, we get natural log n into we get n into ln into 1 plus in is equal to ln plus 1 plus I plus ln into 1 plus e1i plus ln into 1 plus e2i, so on, till we have ln into 1 plus en minus 1i. Now, since the log of 1 plus x approximately equals x when x is small, we can write that in is approximately equal to I plus e1i plus e2i plus so on up to en minus 1i divided by small n. Forecasting future yield rates. Expectation hypothesis can be used to obtain market forecast of future yield to maturities. Suppose you do not know whether short-term yield rate will rise or fall. All you know is current yield on a 1-year bond, that is I is equal to 6%, and yield on a 2-year bond I2 is equal to 8%. Expectations hypothesis can be used to know what market believe the future 1-year yield rate will be, even if investors do not directly report their estimate. We know that I2 is equal to I plus E1I upon 2. This implies E1I is equal to 0.08 into 2 or 0.08 into 2 minus 0.06. That is equal to 0.10. Thus, based on information currently available to you about yields on short-term and long-term bonds, you get to know that market thinks that 1-year bond yields will rise to 10% next year. Hence, varying shape of yield curves are due to different expectations of future short-term yield rates. Segmented market hypothesis. Unfortunately, the explanation given by the expectation hypothesis for the shapes of the yield curve is far from complete. Yield curves are normally observed to be upward sloping. This would imply that investors always expect future rates to be higher than current rates. In contrast, short-term current rates are as likely to rise as they are to fall. Other hypothesis to explain the shape of the yield curve is the segmented market hypothesis, which at the opposite end of the spectrum from the expectations hypothesis. It states that the yields of bonds are determined independently of one another, and bonds with different maturities are not substitutable for one another. Hence, markets for bonds with different maturities are separate. In each segmented market, the yield is determined by the intersection of the supply and the demand for each type of bond. Thus, separate market exists for 1-year bonds, 2-year bonds, and so on. The interest rate on a bond with 1-year maturity is determined or determined in its specific market independently of the interest rates on bonds with other terms to maturity. An increase in demand for 2-year bonds, raising the interest rate on 2-year loan, affects neither the market for 1-year bonds nor the market for 3-year bonds. We can see that in figure 3. The rationale for segmented markets hypothesis is that investors have preferences for bonds with particular terms to maturity and would not purchase a longer term bond or selling it prior to maturity because it minimizes transaction costs, the time and effort needed to make the investment decision, and interest rate risk. The segmented markets hypothesis thus implies that the relative supply of and demand for bonds of varying maturity determines the shape of the yield curve. For a given demand for loanable funds, when the supply of long-term loanable funds is greater than the supply of short-term loanable funds, you will find that long-term interests or in long-term rates will be lower than short-term rates, leading to forward sloping yield curve. In this, we can see that we have three possible scenarios. We have market for 1 year loans, market for 2 year loans, and market for 3 year loans. And we have loanable funds on the x-axis, and we have yield on the y-axis in these diagrams. The figure shows the segmented markets for 1, 2, and 3 year loans. An increase in demand for 2 year bonds, raising the interest rate on 2 year loan, affects neither the market for 1 year bonds nor the market for 3 year bonds. The rationale for the segmented markets hypothesis is that investors have preferences for bonds with particular terms to maturity and would not purchase a longer term bond or selling it prior to maturity because it minimizes transaction costs, the time and effort needed to make the investment decision, and interest rate risk. The segmented markets hypothesis thus implies that the relative supply of and demand for bonds of varying maturities determines the shape of the yield curve. For a given demand for loanable funds, when the supply of long-term loanable funds is greater than the supply of short-term loanable funds, long-term rates will be lower than short-term rates, leading to downward sloping yield curve. The segmented markets hypothesis is also subject to two criticisms. First is that it is not very useful in forecasting future changes in the pattern of yields. The second criticism is that the theory implies that short-term and long-term interest rates are completely unrelated. Preferred habitat hypothesis. The preferred habitat hypothesis combines important characteristics of both the segmented markets and expectations hypothesis. The hypothesis says that while investors have a preference for bonds of a given term, they are willing to substitute away from their preferred terms if they are compensated for doing so. The compensation required to induce investors to purchase an asset with a different terms to maturity is known as the term premium. Hence, an investor will choose financial instruments on the basis of both the expected return on the financial instrument and his or her preference for a particular maturity. An investor will purchase a financial instrument with an undesirable term to maturity only if the investor receives a term premium. If we let beta n be the term premium required on a bond with a term to maturity of n years, the preferred habitat hypothesis states that the yield on the bond IN is determined by the term premium plus the average of the expected short-term interest rates over the life of the n-year bond. That is, IN is equal to beta n plus I plus E1I plus E2I so on up to En minus 1I divided by n, where I is the interest rate on 1 year bonds and ETI is the expected interest rate on 1 year bonds in year T. The term premium is required to compensate the investor for the additional risk and transaction costs involved in purchasing an undesirable financial instrument. Unlike the other hypothesis, it explains why yield curves are more frequently upward than downward sloping. Even if short-term interest rates are expected to remain constant or fall slightly, the yield curve will slope upward due to the term premium on longer-term bonds. Only when investors expect future short-term interest rates to fall dramatically, we get a downward sloping yield curve. The preferred habitat hypothesis implies that short-term and long-term interest rates will tend to move together, interpreting the yield curve. The yield curve is a potential source of information about future economic conditions. Another term often used by economists relating to yield curve is yield spread. Larger the spread steeper is the slope of the yield curve. Following are certain hypotheses regarding the information content of the yield curve. The yield spread contains information on future yield rate movements. An upward sloping curve reflects an indication of the rising short-term yield rates. Thus, a significant positive correlation has been observed between yield spread and future short-term yield rate changes. The yield spread reflects the direction of future inflation changes and credibility of monetary policy. When long-term expectations of inflation rise, investors demand higher long-term yield rates, resulting in steepening of the yield curve. Hence, yield spread also indicates credibility of monetary policy in containing inflation. Improved credibility results in lower inflation risk premium, resulting in a flatter yield curve. An inverted yield curve signals deflation, reflecting impending recession and lack of effective demand. The yield spread contains information on economic growth. During recession, investors turn risk averse and demand less of longer maturity bonds due to higher interest rate risk, leading to decline in price of long-term bonds and consequently increase in their yields. Also, due to accommodative monetary policy, short-term yields remain low, resulting in an upward sloping yield curve. Thus, during recession, the steeper the yield curve, the stronger is the economic recovery expected. The yield curve spread contains information also on credit market conditions. Increase in investment leads to an increase in the supply of long-term bonds by corporate or government, as a result of which price of long-term bond falls and long-term yields rise. Hence, a steeper yield curve is an advanced sign of higher real economic activity. Conversely, a negatively sloped yield curve is an advanced sign of a recession. A flat yield curve is an indicator of weakening economy. As shown in the figure, we have the yield curves, the original yield curve, which is relatively steeper, and the flatter yield curve after tight monetary policy. I'm sure you can observe we have terms to maturity on the x-axis and yield percentage on the y-axis, where two examples are 1 year yield curve and 5 year yield curve on the x-axis, and we find that how the gap between the flatter and the original curve has reduced later on. This yield spread reflects the stance of monetary policy. A flat yield curve, which means a low yield spread, reflects relatively tight monetary policy, and a steep yield curve, which means a high yield spread, reflects a relatively loose monetary policy. The impact of monetary policy is felt the most at the short term of the maturity spectrum, which then gradually gets transmitted to the longer end. When monetary policy is tightened, short-term rates rise more than the long-term rates, resulting in flatter yield curve. This may even give rise to a negatively sloped yield curve. Similarly, when monetary policy is accommodative, short-term rates fall more than long-term rates, resulting in a steeper yield curve. Yield curve in emerging market economies. The yield curve tends to be flatter in emerging economies. Following are some reasons put forward for flatter yield curve for developing economies. 1. Countries with large-scale foreign exchange inflows tend to have flat yield curves, as in the wake of continued foreign exchange inflows, resulting in surplus liquidity conditions. The yield curve flattens as the long-term yield falls. Second, There is dominance of hold to maturity investors, for example, like insurance companies and pension funds, and statutory requirements in developing economies. Investors in developing countries have to constantly churn their portfolios to minimize the market risk. On the other hand, investors in developing economies prefer longer maturity segment as there is less of market risk in EMEs, as the financial market in EMEs are still in its development phase and is more supervised and regulated, unlike developed countries where market fluctuations greatly impacts the financial markets. The reason also is the increased credibility of monetary policy in the past in many EMEs, which has led to lower inflation expectations, causing the yield curve to be flat. High saving rate in Asian EMEs in comparison to many advanced economies can also be a reason to a flatter yield curve in developing economies. Let's summarize the discussion of this module. We have learned that bond is a debt instrument issued by the issuer, which could be a government or a company, to raise funds and provide regular interest payments in addition to paying their face value at maturity to bondholders. Face value we know is the amount that will be paid when the bond matures. Yield to maturity is the interest rate at which the price paid for the bond would have to be invested to return the stream of payments generated by the bond. We know that the term structure of interest rate refers to the relation between maturities of bonds with its yield. Ceteris paribus, which you know means other things being constant. So by ceteris paribus, in this current context, we mean the issue of the bond is same and the date at which different yields are obtained is also constant. We have now learned that according to expectations hypothesis, longer term yields are an average of the shorter term yields expected to prevail during the life of a longer term bond. This hypothesis is based on the assumption that investors are concerned only about expected return from asset. We have also understood and discussed the segmented market hypothesis, which states that the yields of bonds are determined independently of one another and bonds with different maturities are not substitutable for one another. The rationale for the segmented markets hypothesis is that investors have preferences for bonds with particular terms to maturity and would not purchase a longer term bond or selling it prior to maturity because it minimizes transaction costs, the time and effort needed to make the investment decision and bear the interest rate risk. The preferred habitat hypothesis combines important characteristics of both the segmented markets and expectations hypothesis. This hypothesis says that while investors have a preference for bonds of a given term, they are willing to substitute away from their preferred terms if they are compensated for doing so. An investor will therefore purchase a financial instrument with an undesirable term to maturity only if the investor receives a term premium. We have also learned how the yield curve is a potential source of information about future economic conditions, such as the yield spread contains information on future yield rate movements. The yield spread reflects the direction of future inflation changes and credibility of monetary policy, etc. The yield curve tends to be flatter in emerging economies.